Hello students and welcome to the first video on property, plant and equipment. Our quote of inspiration today is by George Bernard Shaw. He said, "Life is not about finding yourself, it's about creating yourself." So you can do and achieve whatever you want. Our study outcomes as per study guide is to apply the acquisition, revaluation, depreciation, impairment, disposal and disclosure of PPE to calculate the cost price of an asset and to present the note property, plant and equipment. So property, plant and equipment is a term that we use to refer to the fixed assets that are kept by an entity. So I know that you have done PPE notes before and you are familiar with property, plant and equipment. These fixed assets then enable the entity to carry its trade and they are applied in day-to-day operations. Now PPE may include the following: buildings, machinery, land, equipment, plants, aircrafts, vehicles, and furniture and fittings. And this is in accordance with the standard that regulates PPE, which is IAS 16. The value of PPE is very, very important. Disclosing an accurate value is of great concern in accounting practices because overstated or understated assets will influence decisions taken by those who have interest, either direct or indirect, in the company. So the valuation methods of PPE are included in the accounting policies of the company. I'm sure you're also familiar with accounting policies. And the valuation of PPE is influenced by the PPE model that is then applied in accordance to your accounting policy. We have two different PPE models that we can use. So we have a cost model. That is the model that you've always done, and that will be slide number 7 to slide number 29, and then your revaluation model, which is slide 30 to slide 65. But the revaluation model I will include in a different video because I think if we put everything together it could be a little bit overwhelming. So for this video we will just first focus on the cost model. So the cost model and its applications. So the cost model is the model that you've always applied when you were still in school or when you came to university and you did accounting 1. That is the cost model that you would have done there. And in the cost model, assets are never revaluated above original cost. They are never revaluated. There are no revaluation surpluses. None of those are measured for the cost model, which makes the cost model the easier model. So for the purpose of this study unit, the cost model will require the following measurements. You will have to calculate the cost price of the asset. You will have to write off depreciation, and I think you are familiar with that. We have a straight line method, reducing balance method, and the production unit method. Those are the methods that we will use in this module. And then you will also have to write off impairment losses by looking at the recoverable amount. So for second year students, the impairment losses will be a new concept. Then we start with the cost price, and this is very, very important that you study these slides off by heart because it's quite theoretical, and they will give you a comprehensive lists of costs that had been incurred, and you need to decide how are we going to calculate the cost price of this asset. So what may be included in the cost price of an asset? We have the initial acquisition costs, which is the purchase price. Then also cost to prepare the site. This is for when it's a building that is being constructed. Then also any delivery costs or fuel costs, any import duties and taxes, any handling costs, installation or assembly, labor costs in construction. So when you have laborers who are building the building, that the cost of their wages may be capitalized. Then registration costs incurred in order to bring the asset into use. Then also legal costs to prepare any purchase documents and agreements, and the cost of testing. The cost of testing will typically be for machinery. So if you have a manufacturing machine, you may first produce a certain set of items just to see if the machine is working properly. So that test run can also be the cost of that test run can be capitalized to the cost price, but you need to remember if these test run items can be sold, then you need to less any proceeds from the samples that were sold. So it's then the cost of testing less proceeds from the samples sold. Then there are certain amounts that will also be provided to you that may not be included in the cost price. So the following must be excluded. Admin costs, that will be your phone billing, bookkeeping, any internet costs, mailing, anything such as that. Then also advertisement and promotional costs. So if you have purchased this new machine and you want to make an advertisement to say you can now produce or manufacture better items, the advertisement cost may not be included in your cost price. Also staff training costs. So if you have purchased a new technology or a new machine and you need to train your staff members to use more sophisticated technology, then the training costs may not be included in your cost price. Then also initial operating losses, that may also be applicable to a machine. If you are producing a new type of item and the production leads to an operating loss where people are not interested in buying the product, but it costs you a lot to produce it. So if you have an operating loss, it may not be included in your cost price. And then subsequent costs incurred after acquisition. So sometimes we need to incur costs even after the asset was or obtained. So these may be like reallocation costs. So if you are moving to a new site or to a new building, the moving costs may not be capitalized to the cost price. Also repairs and maintenance. If you have to maintain the asset, that amount will be expensed. And also valuation costs. So if you apply the revaluation method and you need to pay a valuator to value the asset, that valuation cost may not be included in your cost price. So all the costs that are listed on this slide, number 10, should be expensed and not included in the cost price of your asset. Then the second one we said is that we need to write off depreciation, and I've already said this. Students are familiar with the concept of depreciation. So I quickly made a few examples just to remind you about depreciation, but I'm sure you are still able to calculate depreciation. A machine is purchased for 100,000 Rand on 1 January 2016. Determine the carry value of the machine for the financial year that ends 28 February 2017. Should A, the asset be depreciated on a straight line basis over 5 years with a residual value of 10,000 and the asset be depreciated on the reducing balance method at 20% per annum with a residual value of 10,000. Now I think what students sometimes struggle with when it comes to depreciation is the meaning of residual value. And the only thing that needs to be done with a residual value is it's deducted from the cost price when you are calculating depreciation. That's the only place that you will ever use your residual value. You just deduct it when calculating depreciation. So for the solution for A, we had a cost of 100,000. Then we said for the year ended 28 February 2016, this asset was purchased in January, so we needed to write off depreciation for 2 months on the straight line basis. So we said 100,000, which is the cost price, less the 10,000 residual, divided by 5 years times 2 over 12 gives us depreciation on 28 February of 3,000 Rand. That leaves us with a carry value of 97,000. Then we need to calculate depreciation also on 28 February. So again, I take my cost price, I less my residual, divided by 5 times 12 over 12, because now I've held this asset for an entire year. Then that gives me a total depreciation of 18,000 and a carry value of 79,000. The solution for option B when we are using the reducing balance method is that we start with a cost again of 100,000, but we are now using a percentage. So again, we will say 100,000 less my residual of 10,000 times 20% times 2 over 12 gives me still the 3,000 and still a carry value of 97,000. Then we need to calculate depreciation on 28 February, and this is now where your reducing balance method differs. Now you start with your carry value So you take the carry value of 97,000, you still less the 10,000 because that's the residual value. You times by 20% and then you've used it for an entire year, so it should be times by 12 over 12 months or by 1. That leaves you with the depreciation of 17,400. So can you see the difference between the straight line method and the reducing balance method? On the straight line method, depreciation is always written off on the cost price. But with the reducing balance method, depreciation is always written off on the previous carrying value that had been calculated. Then we have calculated 17,400 depreciation, and the carry value is then 79,600, which also differs from when the straight line method was applied. Then we have the production unit method, and you've also seen this method, and this is when we determine a total number of items or kilometers that a machine or a vehicle or whatever will be able to produce. So in our example, I said a vehicle is purchased for 150,000 on 1 January 2014. It is depreciated over a total of 1.5 million kilometers. So the following kilometers were traveled in 2014. It was 200,000, and in 2015 it was 180. So if we do this journal, we'll say it was 150,000 divided by the kilometers times the kilometers traveled. So it was the 180 in the year 2015. There's no residual value in this example, but had there been a residual value, then you would deduct the residual value from the cost of 150,000 first. So that was our depreciation methods that you can look out for in this module. Then I want us to start with the new concept of impairment losses. So an impairment loss is an additional amount that's written off above and beyond depreciation. So impairment losses are normally written off when assets have been damaged or when the value deteriorated significantly. So when will the value deteriorate? For example, with technology, we often see that there are new computers and new machinery, so then your asset is worth more due to technological advancement. So an impairment loss is then measured, which is an expense. And the double entry for this is impairment losses. You debit your impairment losses and you credit your accumulated depreciation. So impairment losses require the carry value of an asset to be written down to an amount that is equal to your recoverable amount. So it's very, very important for you to know what the recoverable amount is. And the recoverable amount is the highest of value in use or fair value less cost to sell. So in a question they will tell you the value in use was this, the fair value less cost to sell was this, and then you need to know you need to look for the higher of those two in order to determine the recoverable amount. When do we measure impairment losses? Well, impairment losses may occur during a financial year or at year end. And this is very important for you to read in your question. When will impairment losses occur? So I've created a table here for you so that you can see what to do. So for impairment losses, you must first determine, is the impairment loss written off during the financial year or at the end of the financial year? And once you've determined that, there are 3 steps that you can possibly apply. And this is very, very, very important. So step 1 for impairment losses is always to measure depreciation. So you need to measure depreciation either up till the date that the impairment loss must be written off, or up till the date or the last day of the financial year, depending on whether it's during the year or at the end of the financial year. The second step is then to determine your impairment loss. So your impairment loss is determined by taking the cost price of the asset less the accumulated depreciation less the recoverable amount. Your answer there will provide you with the impairment loss. Then step 3 is only done when your asset is impaired during the financial year. So at the end of the financial year, no step 3. For during the financial year, step 3 is done, where we measure further depreciation. So you have measured your depreciation, then impaired the asset, and then you also have to measure depreciation for the remaining part of the year, because this occurred in the middle of or in 3/4 through the financial year. There you take your recoverable amount, you less your residual value, and you divide by the remaining useful life of the asset times months until the year end. So this may sound a bit difficult now and a bit abstract, but that's why I created an example for you so that you can see how you should do your impairment losses. So this is an example for an impairment loss that is measured during the financial year. It says Bella Limited owes machinery and it had a cost of 120,000. Depreciation is written off on the straight line method over 5 years and it has a residual value of 20,000. Bella Limited has a financial year end of 31st December. On 1 January 2014, machinery was correctly disclosed as follows. We had a cost, we had an accumulated depreciation, and that was 120 and 30,000. Then, on 30 April 2014, machinery was severely damaged. On this date, the fair value of the machinery was 70,000, while the cost to sell was 5,600. The value in use on 30 April was 65,000. And on 30 April, the remaining useful life of the asset was 38 months. Now you need to indicate the journal entries that should be processed for the year ending 31st December 2014. So we need to apply step 1. Step 1 was to determine the depreciation. So I've said here it was the cost less my residual divided by the total life of 5 years times 4/12, which gave, and the 4/12 was for January, February, March, and April. So here we will include April because it's on the last day of April. So there I've calculated my depreciation up till 30 April to be 6667, and this was rounded. The answer should be 66.6667. So I've rounded it to the nearest R1. Then step 2 was to determine the impairment loss. So here we said the impairment is the cost less the accumulated depreciation less the recoverable amount. So the accumulated depreciation was the 30,000 Rand at the beginning of the year, but also included now in the 666 is the 667, also to be included in your accumulated depreciation less your recoverable amount. So now we need to determine the recoverable amount, and the recoverable amount is the highest or fair value less cost to sell or the value in use. So the fair value was 70,000 less the cost to sell was 5,600, which leaves us with a 64,400. The value in use was given as 65,000. So the recoverable amount should be the higher of the 64,400 or the 65,000. So obviously your recoverable amount should be the 65,000. So now we can determine our impairment by saying it's the cost of 120 less the 30,000 accumulated depreciation at the beginning of the year plus the less the 6667 of the accumulated depreciation less the 65,000, which gives us an impairment of 18,333. Then we need to determine the depreciation at year end. So there we need to take the recoverable amount less the residual divided by the remaining useful life times the months till year end. So there I've said the recoverable amount was 65,000 because it was the higher one, which was the value in use. I deduct my 20,000, which is the residual value that was given to me. Then I divide by the 38 months, and the 38 months was given to me. It says on 30 April, the remaining useful life is 38 months. And I times by the months till year end. So this was in April. So we have May, June, July, August, September, October, November, December. So till December gives us a total of 8 months. So the depreciation that we need to book is 9 of 473.68, or when we round it, it's 9474. So how do I do my journals? Well, I need to do journals for each little step, step 1, 2, and 3. So in step 1, I will recognize my depreciation. In step 2, I will recognize my impairment losses, and here they've called it accumulated depreciation and impairment losses. But if you just call it accumulated depreciation, you always also get your mark. And then step 3 is the journal for the last bit of depreciation, which was 9474. So this is an impairment at the beginning of the year, and I think the most important thing for you is to study these steps off by heart, to know how do I measure. I need to measure depreciation first, then I need to measure my impairment, and if the impairment is done during the year, I also need to apply this formula. So I think a lot of PPE actually it's important for you to remember that a lot of studying goes into this. So I've also created for you a PPE note just to show what the note should look like. So at the beginning, we have information that was provided to us. We have 120,000 less 30,000 gives us a carry value of 90,000. Then we had the depreciation. There we add the depreciation up till April and then up till year end. And also our impairment loss that we've recognized is also booked here now under the movements, and it's deducted. So the cost is 120, but now my accumulated depreciation and impairment losses is the accumulated depreciation that I started with, plus my new depreciation, plus my impairment losses, which leaves me with a carry value of 55526. I've also created an example here for an impairment loss that is measured at the end of the year. So Bella Limited owns machinery. Again, it has a cost of 120, depreciation written off over 5 years, residual value still 20,000, and then it's exactly the same information as previously, but now the impairment is done on 31st December 2014, but still the same values, same recoverable amount, and so on. So there, again, you will determine your depreciation, but now depreciation is not measured up till April, but for the full year. So we'll say 120,000 less the residual value divided by 5 times 1 or times 12 over 12 gives us 20,000. Then our impairment is the cost less the accumulated depreciation, which is the 30,000 given, and the 20,000 that we've just calculated less the recoverable amount. A recoverable amount is still fair value less cost to sell, value in use, and I still need to choose the higher one, which is still 65000. So there, my impairment loss is then 120 less 30 less 20 less 65000, which gives me an impairment loss of 5,000. And now I don't have to do step number 3 because it's measured at the end of the year. My journals, again, I will book my depreciation first, and then I will book my impairment losses. Also important, no step 3 journal, because step 3 was not performed. For property, plant and equipment, again, the 120, 30 and 90 provided at the beginning. Then I have depreciation of 20,000. I have an impairment loss of 5,000. My cost is still 120. My accumulated depreciation is the 30 plus the 20 plus the 5,000, which leaves me with a carry value of 65000. So thank you very much for watching this video, but remember this was just video number 1. You should also watch video number 2. And in video number 2, we are going to learn all about the revaluation model and its applications. Thank you.